Hi, and welcome back again to Tim Bigham's Big Time Options, Edges and Hedges. We'll take a look today at UOA, unusual option activity today, or in this case, really unusual option activity, as three of the big sort of AI related names have seen just massive repeat call buying, driving implied volatility to by far the highest level we have seen ever on these names. And the best way to take advantage of it in a defined risk fashion, we don't know how high AI will fly, but we do know that eventually the rally will start to die. So let's take a look at three iron condor trades, right, that are fairly delta neutral, right, in Micron Technology MU, Intel INTC, and Qualcomm. So let's jump in and take a look, shall we? First of all, here are the scanners from Friday. Here are those three stocks I just talked about showing up near the very top of the list. Qualcomm with big repeat call buying again, another 625,000 options trading, most of them on the call side, right? Dwarfing the average volume by over 8 times, right? More importantly, implied volatility at the highest level. We'll see just how high we have seen in the past 12 months on Qualcomm. Intel, same way there, almost 2.8 million contracts trading, right, versus well under 700,000 average volume, over 4 times the normal option volume, and again, implied volatility at the highest level we have seen. Micron Technology, over 1.5 million contracts traded, nearly triple, right, the normal volume. And this is with all three of these stocks racing to all-time highs, and implied volatility at all-time highs here as well. So rather than saying, hey, this thing is going to stop going up, I think taking advantage on the implied volatility front is a better way to position, especially short term, to kind of capture the fact that the speculation on these three names is getting to an extreme. And we're not looking for it to come crashing down, just looking for it to cool over the next several weeks. Here's another scanner. This is the one I built on the Thinkorswim platform. And you can see Intel, Qualcomm, the top two names here. Micron not too far below it. So these three names certainly seeing the vast majority of the volume, right? And notice these are all on the call side, right? As far as the unusual option volume. So certainly things getting a little frothy, a little speculative on that front as well. So also the fundamentals, as we always like to say, pulled off. Here's Micron, right? You can see IV at the 100th percentile, right? So the richest option prices have been in the past year, and we'll see in a second, in the past 20 years by far, right? Also seeing valuation multiples starting to get stretched, price to sales over 12 times. Notice too, all of these have had earnings. The next earnings isn't until either late June, right, or late July. So we want to always stay out of the way of events such as earnings, right? Qualcomm, same thing here, 100% as far as implied volatility level. We can see that price to sales pushing, to the richest we have seen in a very long time. Also, Intel, same way as well. Again, here is a basically just yearly, if you will, from January 1st till now, price to sales chart on Micron. You can see now price to sales over 14 times, by far the richest level we have seen this year, right? Previous high didn't even hit, anywhere near this level, right? And not too long ago, it was trading at half of that valuation multiple, right? About a month ago at about 7 times. Qualcomm, again, now over 5 times price to sales, right? The high back here was just over 4. So Qualcomm certainly getting richly valued. And all these include the latest earnings on these, right, which were nice, no question about it. But now the price action starting to outpace how big that kind of earnings beat is, how much earnings will have to continue to grow over the foreseeable future to support this is getting extreme. And Intel certainly has ramped up on a price to sales approaching almost 12 times price to sales. A month ago, you're looking at only 4 times. So certainly on a valuation perspective, these stocks getting a little bit overdone perhaps. Not looking again for them to come crashing down, because God knows in this market nothing comes crashing down too hard, it seems like. But at some point, I think a slowdown is all we're looking for. So that sets up ideally for a few trades that we'll take a look at in a second. From an implied volatility standpoint, we always like to look at that, right? That's what we like to combine here whenever we take a look at putting on a trade, that fusion approach, right? We just took a look at the fundamentals. We'll take a look at the second at the technicals and implied volatility analysis. So from a technical perspective, here you can see MU, right? Certainly getting to the highest level we have seen ever on Micron technology. 9-day RSI now back over 80. MACD at the highest level by far of the past year. Bollinger percent B, which is implied volatility based, also basically at the highest level. Even with IV at the highest level, we have seen shares trading at a massive premium to the 20-day moving average. You can see previous times when it got to somewhat similar levels led to at least a slowdown and a pullback slightly in the shares on Micron. From a perspective of implied volatility, this is, I think, the biggest edge that we have here on the trades. You can see IV continues to make fresh new highs here from Thursday in red to Friday in close. You can see IV lifted across the entire implied volatility term structure. So IV at by far the highest level we have seen, right? And here's a nice chart, I think, a nice table to look at on a 20-day basis. It was under 68 20 days ago, now almost approaching 88, a huge run up in IV, right? We've had earnings too. We saw the earnings rush, and not really much of an earnings crush. Now we're seeing it head higher. As we said, here's Micron earnings, right? Going back to 318, we have not seen much of anything since then as far as the pullback in implied volatility, since IV is now at the highest level ever. June options, the traditionals, seeing the vast majority kind of the volume here, at least on the shorter term basis, ran up about 10%. And here is a basically, longer term chart on MU going back 5 years, right? You can see implied volatility now at by far the highest level. This is a 60-day 30 delta call. Implied volatility by far the highest level we have seen in those past 5 years, right? Nothing even close, right? We did see that, rip and dip on implied volatility here, right? But now off to the races yet again. That sets up ideally for a iron condor trade on MU. So here's the trade we're looking at going out to the traditional June options, right? Giving ourselves plenty of cushion, right? So selling the June 1,000 110 call spread and 500 490 put spread, selling in an iron condor fashion, getting over $2 on the trade. Right, stock closed just under 750. So here's the particulars. Stock closed at 746.81. That $1,000 call strike gives you 253 points of upside from where Micron closed at here. And that's a stock that has been absolutely off to the races, right? And I also like to use the technicals to structure our strike selection. So here's kind of the downside put strike we're selling, right? Upside call strike, not even on the chart. That's how much this rally has gotten, if you will, out of control here going forward. So that gives you over 33% upside cushion from where Micron closed on Friday at 746.81 before the trade gets in trouble. Downside, that 500 put gives you over 33% downside cushion, right? So basically, if the stock doesn't move 33% and we only have a little bit over a month to go on the trade, right? If it doesn't, in essence, close up or down 33% from here in a month, right, you get to keep that $2 and change net credit. So I said, oh, we can sell it for $2.25, allow a little slippage. Excuse me. The risk on the trade, $775. That's simply the 10-point wide strike minus that 225. Gives you a very nice return on risk, right, of 29%. So basically, if the stock doesn't move additionally massively from here, you get to keep that 225 bucks, right? And you have defined risk. You also have the ability to sell shorter term puts or call spreads against whatever side of the trade starts to get in trouble, right? To bring in more additional premium and hedge your risk. Intel, same sort of idea there, right? Intel, as you can see, trading at by far the highest implied volatility. You can see that huge run up from Thursday in red to Friday in green, and on the June side, ripping another 14 points higher. No end in sight, but the nice thing about implied volatility, there always is an end in sight, right? And you can see here again, 20 days ago, IV at 73 and change, now over 95. So you see this huge run up in implied volatility, even with earnings coming out. Earnings came out right here. We saw the huge, kind of vol crush, but now we're seeing it far exceed that level even pre-earnings, right? You also see that calls getting back to an extreme, trading at a higher IV than the puts. Normally it's the reverse of that. And here's a 5-year chart on Intel. No question about it, at by far the highest implied volatility level over the past 5 years. You can see every previous spike that you see, right, quickly met with a pullback. We expect that to happen again, right? And we're doing these trades all in a defined risk, somewhat delta neutral fashion, right? So that sets up ideally for that iron condor and Intel, right? Intel closed just under 125 on Friday, so it'd be selling the 165, 170 call spread, the 90, 85 put spread, giving plenty of cushion on this trade, right? So you have over 40 points of upside cushion, or roughly 32%, and 35 points about of downside cushion, or almost 28%. So plenty of room for the stock over the next 38 days or so, let's call it a month and a week, right, to continue to, kind of move. But as long as you don't hit a absolute flush or crush, right, then you should be just fine on this trade. And again, selling this case a 5-point wide spread. And I said instead of the $1.32 that it closed at, for $1.25, so you can bring in 125 bucks, risk 375 bucks, so your return on risk of 33%. So that is another iron condor to absolutely consider. Same idea here. You can sell shorter term weekly put or call spreads to kind of further hedge the trade if it does, for whatever reason, start to get in trouble either to the upside or downside. But plenty of cushion because of that huge run up in implied volatility. Anytime you see this huge move in IV, right, you can get further out of the money for the same net credit. You can get a bigger net credit for the same out of the money, or what we like to do, kind of, hunt in between there, get a little bit more net credit and a little bit safer margin, simply because IV, that speculative fervor, right, has given you an additional edge on the trade. Then finally, Qualcomm on the trade. You can see here's that IV Qualcomm absolutely continuing to go parabolic here. Here you can see from Thursday to Friday, a huge run up again across the entire IV term structure, right? And again, taking a look, here's IV 20 days ago till now, under 42, over 73 now. The calls trading at over a 4-point IV edge to the puts, right? Normally, the puts trading at a slightly higher IV, which is normal. Here you can see the June options with big volume again, right? Up almost 20 vol points, so that massive bump up on Friday sets up ideally for a somewhat neutral, absolutely, vol capture trade. And here's, really what we're looking to. So the 170, 160 put spread, right? 10-point wide spread, right? And then on the call side, the 270 or 280, excuse me, 290 call spread. So that gives you over 60 points additional of upside on Qualcomm here, or over 27%, right? The downside gives you almost 50 points downside cushion, right? And that's for, again, just a little over a month, or over 22%. Why? Because IV is now at 74, right? You can see what IV was at before, right? Was down around here. We've seen this huge spike higher, and this again is that 5-year chart on Qualcomm for IV. So all we really need is for IV to come back down somewhat here would be beneficial for the trade. We can take it off for a gain, or the stock not to continue to absolutely rip higher here. And Qualcomm, as you can see, is very similar to Intel and Micron, where you're just seeing this massive run up. So again, using previous sort of technical now support levels to structure our short put strike price, right? And then our short call strike price, basically off the charts again here on Qualcomm. Same thing on Intel, right? That stock certainly has been off to the races, no question about it, right? Getting overbought on every technical metric, right? Implied volatility at the highest level we have basically ever seen on Intel, right? So saying let's do a trade that looks to more capture that vol, that huge spike in vol, right? That huge run up like we see here in Qualcomm, like we see here in Intel, right? Like we saw in Micron, right? Looking to sell IV, having it revert back down, and at the same time looking for these huge stock rallies to at least slow down. That huge spike in IV gives us a very nice cushion to take advantage of it. So we'll see, how things work out. But as we know, trading, as we always like to say, it's about probability, not certainty. These are defined risk trades, right? You know what you can lose on the trade, right? You're only risking what you want to risk. It doesn't matter how high or how bad things go, right? On Qualcomm, your max risk is $775 for each one you put on. You can make $225 for that 30% return. Intel, same kind of idea there, risking a defined amount to make a very nice return, and same on MU. So we'll put these trades on. We'll keep you updated as far as how they go, but taking advantage of these huge spikes in implied volatility, right? And it may go a little bit higher, but on these defined risk trades, you have the latitude to stay with it and the ability, if it does go higher, to take advantage of the further spike in IV, which is probably not likely to happen, but you never do know, right? Trading is about probability, not certainty, but an additional spike from here means you can use that to hedge in a even more richer fashion, get further away and get a very nice credit. So until next time, as always, here's to good trading. Take care.